As an experienced tax accountant, I have seen many taxpayers get a surprise tax audit from the government. In this video, I'm going to show you the 4 signs that make taxpayers stand out from the rest and almost guarantee they will be picked for an audit. I will also show you how you can reduce your chances of getting an audit. So make sure you watch until the end of the video, as each reason can help you avoid a costly tax audit in the future. Here goes. Number 1. You didn't declare all of your income, including from your forgotten investments and bank accounts. This is the most common reason you'll get some type of audit. It's easy to forget about dividends from shares, interest from bank accounts, or salary or wages from a job you worked only for a short period of time in the year. However, the Australian Taxation Office doesn't forget. Instead, it receives details of all payments made to you by most institutions, including banks and investment companies, among many other institutions. The ATO uses complex electronic data matching techniques to check if you declared all your income in your tax return with information they receive separately from these institutions. This data is also used by the ATO to pre-fill your tax return with details of your income starting from around late July each year. Most of the mistakes taxpayers make often happen to taxpayers who lodge their returns very early in July and just after tax year end on 30 June. If you're lodging your tax return early, then the risk of missing income is very high unless you have very accurate records. Sometimes your records may not be enough if you have investments in managed funds that are still finalising the categories of income they have paid to you up until late August each year. You see, many bank and investment companies have not had time to finalise their financial year-end reporting of all the income they have paid to you until at least late July, and sometimes not until late August, particularly for investments like managed investment trusts like VAS or VEHG as an example. So for many taxpayers with investment income in particular, it makes sense to wait until at least the end of August before lodging a tax return. Number 2, you didn't declare a gain or loss from selling shares, property, cryptocurrency, or other assets. If you have sold something of value, then you'll likely have to report a capital gain or loss. These events don't happen every year, but when they do happen, often there is a large gain or loss that should be reported and have tax paid on. It can be a big mistake to not include a capital gain in your tax return, as it is likely to eventually be noticed by the ATO through other data matching techniques. The ATO eventually will get a list of property, share, and crypto sales from the exchange that facilitated the transaction for you, and the ATO will match those records to see if you reported a capital gain or loss in your tax return. If you don't include them, then you could get audited. And if you found that interesting, please hit the like button to let me know. And also remember to subscribe to see more videos with ideas to save money. Number 3, you didn't declare income from a side hustle business. Side hustles or side businesses that you work on part-time can often be considered taxable income. That is, unless it is a small-time hobby or you don't make a profit from it, in which case it is not assessable income. You may have earned business income and not even realized it. If you have a profitable business after paying for expenses, then you probably need to declare this income in the business income section of the tax return and pay tax. The ATO has many ways of catching people out of running side businesses, so beware of unexpected audits if you're not declaring all your business income. If you're paid electronically, many companies you deal with could be supplying the ATO with data that may indicate you are running a business, and you may get audited if you don't declare any business income. For instance, if you get paid money for creating videos on social media or getting paid commissions for referral links, the company that paid you would likely be sharing that information with the ATO. Number 4, you claimed very large amounts of tax deductions that are not normal for your stated occupation and previous tax return history. The ATO always check the type and value of tax deductions you claim against what you have claimed in the past, looking for any large increases that are not realistic. The ATO can audit you on the basis of these large variations alone, so be careful when you claim and ensure it is correct beforehand. Also, in your tax return, you are required to describe your main occupation. The ATO will then compare your tax deduction claims with a typical taxpayer with the same occupation in the area where you live, and if your claim of certain work-related tax deductions are higher than average or what they expect, then the ATO will likely audit you too. Imagine you had 100 taxpayers that worked in retail in Sydney and they all earned around $40,000 in the same tax year. If 95 out of those 100 employees claimed no work-related tax deduction, 4 claimed $300 of work-related travel expenses, and 1 claimed $2,000 in work-related car deductions, which one do you think would get picked for an audit? That's right, the one that stands out. The best way to avoid a tax audit is to amend your tax return for any mistakes or errors that you think you may have made, and the video on the screen will help explain how to fix these errors and minimize any fines and penalties before you get picked for an audit. It's really easy to fix mistakes yourself online using the MyGov website. See you in the next one.